Just 8% of UK household wealth is held directly in investments, the lowest in the G7, with a massive £614 billion sat in excess cash beyond emergency funds. The reasons people give are always the same: lack of knowledge, fear of making a mistake, and it feels too complicated. So where did all this come from? Why are we so different, and what can we do about it? Investing at its core shouldn't be complicated, but something made it feel that way. There's parallels with so many other industries. One of the biggest ones, I think, is fitness. What was once a relatively simple concept is now sold as something you can't do without a periodized plan, specific supplements for each goal, and the perfect morning routine. The underlying information didn't really change. All that changed was how it was packaged and marketed. Things are simple until they are commercialized, and investing has followed almost the exact same path. And it's because complexity sells. I started working at Invesco in 2012, just before the Retail Distribution Review came into effect. This was a set of regulations aimed at improving transparency for retail investors, with the biggest change being how advisors were paid commission. Before this, advisors could be paid directly from fund managers through what was called renewal or trail commission. This was also a time when mutual funds dominated the space. These funds, on average, had an ongoing charge of around 1.5%, and from that fee, the typical commission paid to a financial advisor was around 0.5%. So from a client's perspective, any advice they received was essentially free, because that advisor would be receiving 0.5% directly from the fund provider. In today's world, this seems such a strange and slightly dodgy setup, but it was how fund providers had to pay for distribution, because the advisors were their route to sales. So after the Retail Distribution Review banned that commission model, advisors had to charge clients directly and, of course, transparently. And in many ways, the review was a massive positive for investors. Anything that increases transparency around fees is a good thing. But it did create somewhat of an advice gap, and although hard to prove, has probably contributed to the UK's poor investment rate. Also during this period, we've seen massive growth in passive ETFs. And in the last few years, passive funds actually overtook active funds by market cap. Investors realized they didn't need to pay for an expensive actively managed mutual fund when they could just track the stock market for a fraction of the cost. Similar to advisors, fund managers have had to pivot on how they offer funds and market them. Ultimately, this has all been good for the consumer. More choice, lower costs, and more transparency. But in a bid to stand out in a crowded market, similar to what happened in the fitness industry, fund providers and advisors have had to differentiate themselves. There's now more ETFs on the market than individual stocks. There's now active ETFs, and even indices created purely for one fund to track, essentially creating an active style investment in disguise. For the advisors who can no longer earn commission for recommending a fund manager, they need a new reason to charge. Now, to be clear, I'm not saying there's no value here. There will definitely be times in your life when financial advice will be very valuable. Usually it's at the start and the end of your working career. But if you paid for advice and they just told you to invest into 3 funds, you wouldn't be very happy or perceive it to be that valuable. So the strategies naturally become more complex. For some people, this will be necessary, but for most, it's overkill. And I'm also not missing the fact that content creators also have a role to play here too. There's only so many global ETF videos you can make. So again, there's an element of trying to stand out. But I think what really gets to me is complexity to justify an ongoing fee. I've seen this firsthand when I recently discovered my 85-year-old grandmother is using a financial planning service, and they've put her in over 40 holdings. What makes it worse is that she isn't even taking income from this portfolio. It's purely for growth. It's just absurd. This isn't an isolated incident either. I had someone comment on a video literally last week saying their friend had used an advisor that put them in 30 different holdings. I totally get an initial fee to create a portfolio, but if you find yourself in this position, ask yourself, what is there really to manage? It's more of a comfort blanket. It's not like managing a fund. When you create a portfolio, you do so with a time frame in mind. You'd make sure it's diversified enough to handle the next 10 to 15 years, and you'd adjust risk accordingly. Remember, the purpose of an advisor isn't to beat the market. It's more so to manage your risk and get you a return in the first place. According to the FCA, the average ongoing advice fee is 0.8% per year, ranging up to around 1.5%. Initial advice is a bit more, as you would expect, and averages around 2.4% of the amount invested. Keep in mind as well, you'll potentially have fund and platform fees too. If you can, always try to pay for advice with a one-off fee, preferably an hourly rate. We'll do a really simple example. Let's say you invest £500 a month and are able to keep this up for 30 years. At 9% growth per year, you'd end up with roughly £858,000. If you were paying a 1% annual fee for managing your portfolio, you'd end up with around £709,000. That's £149,000 in fees, before you even got to any initial fees and trading costs. At the end of that 30 years, you'd be paying over £7,000 a year. So what should a portfolio actually look like? Of course, there isn't a one-size-fits-all approach here, but there's a few principles you can follow. What are your goals? Are you trying to beat the market or just track it? Do you need to reduce volatility? Are you accumulating or decumulating? 2 or 3 funds can give you global diversification across thousands of companies. You could even say you can get this with just one global fund. And then in terms of further options, you may look at a global approach and decide you want to have a small tilt to a specific region or sector. You might want to add some precious metals, such as gold, as an equity hedge. Perhaps some bonds to help reduce volatility. That could be a mix of corporate and government bonds. With the equity part of the portfolio, you may decide you want to have a weighting towards strong dividend payers rather than growth companies. Let's throw in some real estate and infrastructure as well for good measure. Even if you had all of these, you still shouldn't really have more than 10 holdings. Think of it this way: if you'd be embarrassed to tell someone what you hold because it sounds too simple, that's a good sign. I'm not just saying keep your portfolio simple because you'll likely get a better return. I also think it will help with your mental health. We've been quite lucky in a way that over the past few years, crashes have recovered extremely quickly. What's going to be a bigger test is if we go through a more extended downturn in the markets. A lot of investors won't have experienced that before. But the most important thing during periods like this is to have confidence in your investments to start with. If you have 20 plus holdings, it's virtually impossible that you'll know enough about them to manage them. When you've got just a few funds, there's far less decisions to make, you'll be less likely to tinker, and overall, you'll just sleep better with a simpler portfolio. You don't need to understand the intricate details about every fund, but you should know why you hold what you hold. If you can't explain why you hold something in one sentence, you probably don't need it. It's also absolutely fine having a handful of active plays if it keeps your hands busy, as long as your core is in straightforward investments that you leave alone. What's worrying for the UK in particular is comparing investor confidence to a decade ago. Just under 2/3 of those in the UK said investing was confusing and difficult to understand, up from 44% in 2015. This is according to Columbia Threadneedle Investments Investor Confidence Tracker. The research also found that 74% would choose an investment that is simple and easy to understand, rather than something they do not fully understand, even if it may deliver lower returns. Again, up from 68% in 2015. And this is probably the biggest one. The proportion of people who avoid investing any of their savings altogether has barely moved since 2015. 40% in 2015 versus 37% today. Over the same period, we've seen significant market growth, meaning millions of people may have missed out on potential returns. And recently, high inflation has eroded the value of their cash savings. There are some positives in sight though. Financial education is going to be included in the national curriculum from 2028. This is extremely overdue. And although we don't know how this will be received, it has to be a step in the right direction. And when it comes to content creators, I also feel we're moving away from the clickbait era, as people know when something seems too good to be true and the creator is just after views. People want transparency and authenticity over anything else. There will always be a risk of losing money with investing, but a guaranteed way to lose money is by not investing because of inflation. It's a lot easier to think about the risk of doing something rather than the risk of not doing something. That's my biggest goal with this channel, to get more people investing and to help them not be afraid of it. Remember, most things in life are simple until they are commercialized. If you're struggling with choosing the right investments and you really want to simplify your approach, I have a free ETF cheat sheet you can download that compares ETFs across various sectors and regions. It's linked down below. I hope you found that useful. Thanks for watching, and I'll catch you in the next one.